Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks steady after notching one of the best days of the year so far. Cameron Dawson of NewEdge Wealth writing, our key message to clients is get comfortable being uncomfortable. We see volatility continuing even as we bounce off of oversold, low sentiment levels. Cameron joins us now for more. Cam, it's good to see you.
Good to see you.
Let's talk about your conversations with those clients.
Yeah.
What are they telling you? Are they freaking out? Are they bearish? What's the response?
Clients are still very calm, and we think it's because if you look at a 70-30 portfolio of ACWI versus the ag, you're still up about 1% for the year. So yes, we have seen this weakness within U.S. equities, but if you are a diversified investor for the first time in a while, you actually feel good about having non-U.S. exposure, which has helped to dull some of the pain that you have seen within the concentrated U.S. markets.
How far out are they willing to extrapolate that recent underperformance, U.S. versus Europe? Are they starting to wonder whether this could be a multi-year game or is it a short-term game?
We're certainly asking that question, meaning are we going to see a repeat of the 2000 to 2007 period where it truly was a multi-year period of non-U.S. underperformance versus the rest of the world? We think it really depends on two key factors. You have to see continued dollar weakness. You have to see much further downside in the dollar to suggest that capital will leave the U.S. and go to the rest of the world. And you have to see it backed up by earnings. So if you look year to date, all of the outperformance of Europe has been driven by valuation expansion. It's gone from 13.5 times to 15 times. Earnings estimates have actually gotten cut. So if you think that this is going to last more than just a couple of months or a couple of quarters, you have to believe in the earnings story.
So how do you understand that multiple shift? How do you understand the idea that we've seen a weakening in the dollar and a sell-off in the S&P 500 for one of the longest periods that we have in the past few decades? If it isn't necessarily some fundamental shift, what is it?
We have to appreciate that we went into this year with a massive record dollar long position. If you looked at futures trading, you had a huge position where everybody was long to their eyeballs the dollar. That has now reversed, and you actually see traders being slightly short the dollar. So we think that the dollar could actually find some stability here. Maybe in the short term you see some mean reversion in some of those trades. The last 2 days, Europe has been underperforming the U.S. So it's very alluring to try to ascribe a narrative to price action, to say end of U.S. exceptionalism, the U.S. exceptionalism story is over. We think it's actually a lot more about dollar positioning, at least in the short term.
Yeah, you've said this question in your notes, which I thought was great. Is it the end of U.S. exceptionalism or just a positioning unwind? Seems like maybe it's a little bit of the latter. I am curious what this means going forward then. If this gives a sense that not only will there be stability to the dollar, but also, say, to the Magnificent Seven, which have unwound at a disproportional pace.
Well, and we do think the weakness of the Mag 7 was a function of its strength at the end of the year. Mag 7 outperformed so much in December that was not justified by the fundamentals. Earnings estimates were getting cut. It was all valuations. So this is all just these positioning shifts moving around. We've now gotten to the point where positioning is a bit more balanced. You've gone from the 98th percentile in U.S. positioning to the 26th percentile. That does set you up for a little bit of a relief rally. The question is, Europe is still trading at 15 times versus the U.S. at 20 times. What's the driver to potentially see those multiples converge further?
You know, you said get used to being uncomfortable. There are a lot of people who say, I don't want to be uncomfortable. I want to have some sort of forward indicator to get an edge at a time where it seems like there's a lot of noise and nothing else. What are you looking for to change materially to get some conviction one way or another?
We have to start from the basis that indicator economics and what used to work in prior cycles does not work in the post-COVID world, which means that we can't look to things like the 10-2 curve of telling us if we're having a recession. We can't look at those sentiment indicators because they've been so misleading. One of the things over the last 2 years that we've been saying is that watch what they do, not what they say, meaning that you cannot look at sentiment and soft data and extrapolate it into hard data. We think it's actually more important to look at what the equity market is saying about the consumer, for example. So look at equal weight discretionary versus staples. If discretionary is underperforming staples, the equity market is sniffing out that there's trouble in River City with the consumer. If it continues to be in an uptrend, then the equity market is telling you a message of it's okay.
Watch what they do, not what they say. Are you also using that same logic when it comes to policymakers in Washington?
Not necessarily. There has been follow through in what they've been saying, and I think that was one of the follies going into this year, thinking that it was all just rhetoric coming out of D.C. and that we wouldn't see policy follow through. But we certainly are seeing it, at least to an extent. Yes, we have the flip flop and the ping pong about how much we're actually going to see tariffs enacted, but there are real policies being enacted, which is weighing on activity that we see today.
April 2nd is increasingly difficult to understand. The Financial Times just put out this report that the president is considering a two-step tariff regime on April 2nd, according to people familiar with the matter. Among proposals, and I'm citing this story directly now, his team has been discussing is a plan to launch so-called Section 301 investigations into trading partners, so that's unfair trading practices, while simultaneously using rarely invoked emergency powers to apply immediate tariffs in the interim. So you could see a couple of phases of this, which is a reason why the people like Max Kettner of HSBC are worried that this uncertainty will linger beyond April 2nd. And Anne-Marie, this is something you've talked about repeatedly. There are things you can do on day one, on April 2nd. There are other things you'll have to wait to execute on.
Right. If you want to use Section 338 or IEEPA, you can maybe use national security lever, and you can have a tariff that day in an executive order. If you want to look at something that is more long-term, if you need public feedback, then you would take weeks or months. But what the Financial Times is saying, and it's something I think makes sense for how Trump likes to enact policy, you might see both on that day. Come out with something really sharp because he wants to deliver, but then at the same time, it's a little bit more nuanced when it comes to maybe specific countries or sectors.
Cameron, this makes April 2nd really tough because is it going to be a clearing event? Maximum uncertainty, move beyond it, move on by stocks, or will it just get more confusing?
I think that Peter Cheer earlier this week was really wise in saying that if we get clarity, is that actually a bad thing, in the sense that the current EPS estimates do not contemplate the kind of tariff regime that's even the tariff light that is being presented, which means that we do think that there is downside to earnings estimates if we get the clarity that people can actually start putting it into numbers. We see this arrested development in decision making. It's if you choose not to decide, you are still making a choice. Businesses are sitting on their hands and not making decisions, and that could result, we think, in lower earnings estimates, which we think challenges the valuations of equities even further.
Bad thing for who? And bad for which equities? The United States or the outperformance we've seen in Europe and elsewhere in China?
I don't think that the European rally has been pricing in the risk of tariffs being escalated, which just means that you're seeing all of this strength in re-rating, which is more of a positioning flip than necessarily thinking that Europe is going to do better because of the tariffs. So if we actually see them enacted, we think it's more of money leaving global equities versus shifting from one place to another.
I'm with you. I love the piece from Pete over the weekend. Careful what you wish for. If you get the clarity, you get the certainty. Is that when we start to fully appreciate the kind of damage it could do to the economy? And I'm not talking about the United States. I'm talking about the rest of the world.
Which is something that people were pricing in at the end of last year and everybody seemed to ignore because they were all benumbed by the idea of Germans spending money, and that seemed to take everyone's idea of what tariffs would do to the rest of the world out of the minds.
Cameron, good to see you, as always. Great to catch up. Cameron Dawson there of NewEdge Wealth. Bank of America cutting their growth outlook for the United States and the world, writing the growth revisions seek to capture the impact of the policy uncertainty shock on spending and capex in the coming months, as well as a more hawkish tariff stance. Claudio Irigoyen of Bank of America joins us now for more. Claudio, good to see you, sir.
Thank you.
First question, hardest question. How on earth do you put out a forecast in this environment? How difficult is that?
It's extremely difficult, but to be honest, sometimes uncertainty is worse than bad news. Because that impacts the decision of companies, irreversible decisions to invest or not. So the option value of waiting is higher when you don't know what's going to happen. And you can see the Fed. The Fed is exactly in the same position. They cannot move the needle until they figure out what's going to happen.
So with that in mind, how bad's Q1 going to be?
Actually, it's not going to be that bad. January data was bad. February data was much better. So probably January was a one-off. We mark to market the first quarter. We expect probably something between 1.5% and 2%. So the first half is going to be around 1.5, 1.7, and the second half is going to be around 2%, which is trend growth. It's not that bad, really.
At the same time, I think what a lot of people are worried about is that tariffs are going to keep the inflation picture a little bit stickier than otherwise was on track for. Atlanta Fed President Raphael Bostic yesterday, speaking with our own Michael McKee, saying that he moved to one rate cut projected for this year because he thinks that the path of disinflation is going to be very bumpy and not move dramatically and in a clear way to the 2% target. Do you agree that that now seems further out of reach?
Yeah, we had the view that inflation was sticky and was going to continue to remain sticky even before the tariff shock. And we expect PCE inflation around 3%, which is too high for the Fed to feel comfortable cutting rates with all that uncertainty that is basically upside risk to inflation. So we have the call that the Fed will remain on hold for the foreseeable future. And inflation will remain sticky, absolutely.
So it raises this question, when you talk about a growth slowdown, and Mohamed El-Arian was on this program and he asked this question, and I've given a lot of thought to it. Slowing to what? If it's not recession, if growth slows to a certain place, does it become really difficult for the United States to sustain the deficit that it has and continue with the growth that it has if you have inflation that is sticky? It's not stagflation, but it doesn't feel great.
It's a stagflationary flavor, let me put it that way. If you have the level of uncertainty that you have over the last 3 weeks for another 3 months, that will have a permanent effect on investment decisions and on consumption. So this administration can change the way it communicates to the market, because the market has no political color. They just price what they see. And the correction in the market is the market telling, we don't like these policies, or we don't understand these policies. So at least communication could be more transparent for the market to understand that if this is a short-term pain for long-term gain, usually markets rally when the net present value of a project is positive. So communication is going to be key. And I noticed in the last 3-4 days that communication is more careful, at least.
Well, Trump has talked about being flexible, at least when it comes to tariffs. When it comes to your inflation forecast, it's very hawkish. Do you view some of this tariffs driven?
For you to have a sense, if you have an increase of 1% in effective tariffs, that gives you between 7, maybe 10, no more than 10 basis points increase in PCE. So tariffs, the 20% tariffs from China, that gives you 2.5 points of increase in effective tariffs. So that gives you already 20 points or so on PCE. And then if you do reciprocity, you can have another 0.5 point in increase in effective tariffs. So you can have a sense. The things get more hairy when you say, okay, I'm going to also take into account when I do reciprocity, VAT. Then it's a completely different discussion.
And digital services tax and currency exchanges, they're looking at everything across the board. That's what the executive order called for. What I'm hearing from you is it's not so much the tariffs, it's the uncertainty. Could we have an uncertainty-driven recession?
Well, you really have to keep this uncertainty level for a while. 3 weeks is enough for showing up in the soft data, as we were discussing before. Still, consumption data remains strong. Our credit card data shows that consumption is resilient. You had massive wealth effects over the last year and a half. Consumers hedged their interest rate exposure big time when interest rate collapsed. They refinanced their mortgages. So the balance sheet of the private sector is fine. The balance sheet of the public sector is not fine. And that remains to be seen how it's going to be addressed.
It's interesting listening to the administration in the last 24 hours when they talk about challenges to the economy. They kind of brush to aside the tariff story. They will accept, though, that DOGE and the rebalancing of the economy away from government spending towards the private sector could be damaging. And we heard that from Stephen Mirren, the chair of the Council of Economic Advisors, just yesterday speaking to Bloomberg News. I don't think there's going to be a material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. How do you and the team think about DOGE and what it could do to your outlook?
I think it's too early to tell. There are a lot of things that the administration say we're going to do it, and it's not easy to implement. The execution risks are still high. But DOGE is another example in which uncertainty is not enough to characterize this economy. You have to add to the uncertainty confusion. So we can agree that tariffs will be 2%, 10%, 20% higher or not on April 2nd. We can agree on the probability distribution of that random event, but we can disagree, and people disagree a lot on the effect of that on the economy.
When it comes to DOGE, is your concern in the effect of the economy on the labor market and potentially the business contracts that you have the private sector doing with the U.S. government?
It's still, when you quantify it, it's still relatively minor and very concentrated on some geographical areas, the DC, etc. But it's going to impact on sentiment, right? So it creates uncertainty of where we are going. So if you have a master plan that has different pillars, energy, immigration, fiscal consolidation, tariffs, you got to put it together and explain to the market, this is what we have in mind. If you do it piecemeal, you create confusion.
Well, they have a master plan, but they're doing it piecemeal in the sense that they're addressing tariffs first. By the end of the year, they want an extension of TCJA, and they want deregulation along the way. If you take the Trump administration's economic policy together, do you think it's a fair outcome?
What we have in our forecast is an economy that eventually will continue running around potential. I think policies can have the right, the idea could be great, but implementation risks are very high. If you impose tariffs in the morning and remove it in the afternoon, even if you end up with 10%, 20% tariffs at the end, that transition doesn't help.
It's difficult to plan with that backdrop, that's for sure.
Absolutely.
Claudio, it's good to see you. It's good to catch up and get your thoughts from the team over at Bank of America. Claudio Irigoyen there. To extend the conversation, joining us around a table here in New York, Libby Cantrill of PIMCO. Libby, good to see you.
Good to see you.
Attempting to read the tea leaves in Washington is a dangerous game, but we're going to play it just quickly. Do you think maybe based on the comments of the last 24 hours, the President and this White House are realising some of the legal constraints around what they can and can't do on April 2nd?
Yeah, and what we know about his trade advisors, Jameson Greer in particular, who's his U.S. trade representative, he is particularly focused on the legality and the durability of these tariff actions. I mean, remember that April 2nd was sort of the date that was set out in the executive order in the first week of the administration that really was supposed to clarify kind of the trade agenda. It was before the Canada-Mexico tariffs, before the Colombia threats, before the aluminum and steel tariffs. So I think in some ways this should, provide some coherence in terms of the trade agenda, but again, the legality I think is very crucial here. One thing that we were talking to clients about is this just an announcement of future tariffs? Is this sort of forward guidance, if you will, for tariffs? Or is this actually an announcement that tariffs are rolling on April 2nd? And I think that actually has to interplay with the legality. If this is being used under IEEPA, then he can do this day one. If this is more of a broader investigation, then that will take several months.
Well, the FT is saying it's both. There's going to be two tiers. Potentially we get some tariffs day one, and then longer term, they're going to look into some trade imbalances. I love that you talk about mind-numbing process, because I actually think it's important whether or not they use IEEPA, whether or not they use 338. Can you walk us through what they potentially have a menu of to enact on April 2nd?
Yeah, I mean, as we've discussed before, the executive branch just has wide discretion in terms of what they can do on tariffs unilaterally. So, of course, they don't need to go through Congress for any of these things. These are authorities that they already have. But they do depend in terms of timing. So Section 301, for instance, that's an investigation that usually looks into a specific country's practices. That investigation can take months. This is the authority that the Trump 1.0 put tariffs on China. So if it's an announcement of a 301 investigation, then again, you're kind of giving the market some forward guidance about what to expect. If they use IEEPA, if they use Section 338 of the Tariff Act from 1930, then
it's huge. It's up to 50%.
Then those can go on day one. So I think this is where Jameson Greer, though, who is a trade attorney by background, again, U.S. trade representative, I think is going to be very focused on the legality of all of this, the durability, and the fact that he doesn't want to be fighting this in courts, right? He wants this to stay. This is supposed to be a part of a broader kind of either national security and economic agenda. And again, he's going to be focused on.
So you're outlining how they may be able to get there legally. What countries do you think they're going to go after?
Yeah, I mean, if you just look at the trade deficit, and this president, people may agree with him or may disagree with him, but he's been incredibly consistent about his focus on the goods trade deficit in particular. And if you look at those countries with the biggest goods trade deficit, it's China, it's the European Union, it's Mexico, and it is Canada. And then he's also going to be looking at the tariff rates. And this is where I think it does get a little bit complicated. I think that reciprocity, broadly in terms of the administration, they agree on this idea of reciprocal tariffs. But how do you calculate that tariff? Does that include things like the value-added tax in Europe? In which case, that reciprocal tariff that we would impose on Europe would be much higher than what the stated tariff level is. So I think there are obviously a lot of open questions about what this actually means. But I do think we will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
Well, the market seems to like the lack of clarity, or just tea leaves that they've been getting over the past couple of days. Have we gotten any further clarity or any more of a sense of what the framework looks like over the different speeches that we've heard over the past few days, kind of in tandem with what the market's sniffing out?
Yeah, and again, is this intentional, kind of a softening, a walking away from some maybe the more draconian measures, or is this maybe just a byproduct of the fact that this was supposed to be really the big reveal, if you will, of the sort of the administration's trade policy, and it wasn't supposed to be necessarily sort of so draconian, I don't think. I think it was supposed to be part of a broader economic strategy, and so I think some of that is we're just sort of seeing that kind of fleshed out.
How much do you think the sequencing of this matters, where they want to get this out of the way and then pencil in certain revenues from these tariff plans to then bring to the tax discussion that is very much going to come to the fore in the remaining months of the year?
Yeah, I mean, we've been using this framework with our clients, the vegetables and the dessert, and we knew that the Trump...
I take issue with that. Vegetables are good, but carry on.
Wait, it depends on what you're steamed vegetables and dessert and ice cream sundaes. How about that?
Thank you. That's perfect.
But we've had a lot of steamed vegetables, right, without salt, and we have not had a lot of the ice cream sundaes. And so I do think this was sort of what we expected, that there was going to be this kind of push and pull in terms of economic policy. But in terms of the market, they've had to stomach much more vegetables than dessert, to belabor the metaphor. So I do think there's going to be a quick pivot to what are the things that they can do from a growth agenda perspective. And then I think the big question, I think, for the markets and for bondholders is, what is the deficit impact? Because I'm skeptical that a lot of these sort of spending cuts that have been penciled into the kind of framework that is being proposed in the House in particular will actually be enacted into law. I think those things are very difficult, easier said to do than actually to do.
You've got Doge doubts. What happens with Doge?
I do have Doge doubts. Now, this is an active discussion within the walls of PIMCO, so this is my personal view. Sure. But if you actually look at, and this is, again, mind-numbing process, but actually quite important, anything that is that Congress has already appropriated, spending that they've already appropriated, that gets then kind of cut or pared back by Doge, that does not go to the Treasury General account. That does not go to pay off the deficit. That by law goes with basically a checking account within that agency and has to sit there for 5 years. This I don't think necessarily the market understands. That means that, again, these make good sort of sexy headlines, if you will, but in terms of actual deficit reduction, we definitely haven't seen that yet, and you have to get that enacted by Congress and codified into law.
Libby, it's good to see you. As always, great to catch up. Libby Cantrill there of PIMCO, breaking things down on both the trade front and the tax front. President Trump reiterating his call for the Federal Reserve to cut interest rates. Sonal Desai of Franklin Templeton sticking with her call for at most one rate cut this year, writing, while tariffs and immigration have come up front, concrete action on deregulation and tax policy is expected to follow, and these are the two elements that should help tilt growth and contain inflation. Sonal joins us now for more. Sonal, good to see you. That's a more constructive view on US growth. A lift to growth at the end of the year, potentially.
Well, I don't know whether we wait until the end of the year, but a slightly more constructive view than perhaps some in the market have taken. At the end of the day, we've had a couple of months of definitely freezing up as everyone, looks at the sequencing being exactly the opposite of what they would have liked to have seen, which was the nice stuff first, and we didn't get it. And we all expected it, and instead we got the complications, the uncertainty, the changes by the Fridays to the Mondays on what policy would be, which gives very little visibility, and markets don't like that.
And yet, even with that, bond yields are north of 4% across the curve.
Yes.
So where will they be as we work our way through the rest of 2025?
So I'm not actually changing my call for fair value on the 10-year to be between 4.75 and 5 here. And that is because I would anticipate that we aren't actually at the point of an actual recession. We're seeing a freezing up of growth, and then there's likely to be a catch-up if we actually see the tax cuts and deregulations which were promised to us, because those are growth positive. Now, we can discuss the long-term impact on debt sustainability, et cetera, of expanding tax cuts, but from the market's perspective, and this year and next year, it's positive if we get that.
What you're saying right now explains to me why yesterday, on a day of maybe relief that there wasn't necessarily another tariff announced or potential softening in some of the terms, we saw the biggest one-day rally in high-yield bonds going back to August of last year. It speaks to exactly what you're talking about, that people are betting that we are not going to get a recession and that riskier credit will do better.
I think essentially that is correct, because every time I see the headlines on imminent recession, I look at those fixed income risk assets, and as far as I'm concerned, there's cognitive dissonance. Nobody's throwing out their risk assets on the back of a recession, which, if it were coming, you would not see high yield spreads where they are. You just couldn't. And the fact is that the market participants are betting on someone coming in and easing pressure on that 10-year yield, which I think is probably not appropriate. The Fed can't do it, and despite discussions from Scott Bessent, there's an absolute limit as to what he can do unless that deficit comes in.
Okay, let's talk about that. He actually came out, and he had made a lot of noise before he became Treasury Secretary about Janet Yellen and her issuing more on the front end as being a liability and not terming it out. Then he came out and he said that he was going to keep that schedule of issuance, and the market rallied because there was a sense that he was sensitive to how issuance would end up affecting bond yields. Why do you think that's not enough at a time when that seemed to be the biggest concern for people?
Well, I think it shouldn't be the biggest concern for people. That's number one, because actually what should be the biggest concern for people is the sheer quantum of the U.S. fiscal deficit, which is enormous. And if we get any piece of the additional tax cuts which President Trump promised on the campaign trail, that deficit is set to expand further. And I see so little appetite for doing anything on what needs to be done to constrain that deficit, which would be on significant pieces of expenditure. And I'm not talking about DOGE here. I'm talking about the stuff, entitlements. That's the bottom line. We're looking at twice the level of expenditure here in the U.S. that, in terms of the deficit that we had pre-COVID. And most of that's coming from entitlement spending. So, no, I don't think that it was purely a supply issue which was driving those yields up and down.
Given the deficit as a restraint, do you think that we only get an extension of TCJA then and none of the extras that Trump did promise on the campaign trail?
That's a really tough call, because he hasn't talked as much on taxes as he's spoken on everything else, which we wish he wouldn't keep speaking about in terms of tariffs and so on and so forth. But he hasn't spoken as much. However, I think a week or 10 days ago, he did raise the idea of full depreciation of CapEx within the first year. Now, clearly that is unlikely to happen, but even a further reduction in the amount of time that CapEx can be depreciated, I think would be viewed as a positive, in part because nobody would see it as truly permanent. So you could see an immediate reaction of firms stepping in to do planned CapEx. It happened last time around because there's no true belief that under a different administration, some of these benefits wouldn't be taken away. So, yeah, I think some of them directionally probably have to happen beyond that main piece.
Some people have been surprised by the sequencing. They might also have been surprised by how other countries have responded to this, specifically Germany. Germany and Europe are about to go on a spending spree, an unexpected spending spree. How has that changed your outlook for fixed income?
So here's the thing. I think maybe a dozen years from now, we're all going to look back and say, okay, so the last fiscal non-reprobate standing was pushed down, and we all cheered. Germany was literally the only country amongst the developed, advanced economies which wasn't spending as if it was going out of style. Here's the thing. Mechanically, yes, growth goes up, but the multiplier attached to defense spending is incredibly small. So it's not as if this is going to trigger a wave of structural reform, innovation, which puts Germany onto this incredibly better growth path into the, indefinite future, which is what you'd want to see. The last thing is, I think it's highly unlikely that we're going to see it just actually being able to absorb those funds into the German economy or any other economy. It's not the flick of a switch. You can't suddenly ask Porsche to start making tanks. It doesn't happen that quickly, is all. I just think these things take time. So some of what we've seen in the reaction of the market seems to be somewhat overdone.
We don't want Porsche building tanks. Sonal Desai, Franklin Templeton. Sonal, not buying the happy talk out of Germany.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.